Hello everyone, welcome to our webinar series for young investors. My name is Rachel and I'm one of the investment managers here at Killik, and my job is to help other people invest their money in the stock market. So I'd like to use these 5 webinar sessions to help you to understand some of the basics. And I'm joined by my colleague here, Tim Bennett, who is our head of education here at Killik & Co, and he's also the editor of the Killik & Co magazine, and he's going to be joining every single webinar session and teaching something specific in every single session. And then behind the scenes, we've got my colleague George, who's going to be manning the Q&A function. So if you have any questions throughout the webinar, just pop them in the chat box and we'll either answer those at the end, or if we don't have time for all the questions, we'll try and email you afterwards with a specific response to your question. So we've put these webinar sessions together to help you guys understand how to invest. We obviously think investing is really important and we think that it's something that everyone should learn about. But also we think it's a real shame that investing has quite a boring reputation. So we really want to show that actually investing can be really interesting, especially when you're investing in companies or brands that you know a lot about or that you really like. So with that in mind, let's have a look at what we're going to be learning about over the 5 webinar sessions. So I'm just going to share my screen with you. So here's our schedule. Here's what we're going to be doing over the course of the 5 webinar sessions. So today we're just going to have a basic introduction to investing, and we're going to talk about something called thematic investing, which is a method that we use to select our stocks here at Killik & Co. And then Tim's going to give you a basic overview of how the city works. And then your homework for this session, you're going to go away and you're going to think about your own stock ideas or your own ideas of different themes or trends that we could invest in. And you're going to send those to me before the next session. And then for session 2, we're all going to download a virtual portfolio app, and we're going to take a vote on which of your ideas we should put in our virtual portfolio. And then we'll spend the following 3 sessions monitoring what's happening in that portfolio. And I can talk you through which of those stocks have moved and why. So I think that's a really great way to learn about what's happening on the stock market. And then the sessions you've got to look forward to from Tim, you've got one today about what the city is about, and then you've got how shares work, you've got what do equity analysts actually do, how to buy shares, and then finally the world of funds. So let's get started. I'm going to start with quite an important question. So the first question for today is, why invest? What is the point in investing in the first place? And the most obvious answer is really to make money, but can we put a bit more theory behind it? And can we really explain why it's important that we do make money with our savings? You've probably heard of something called inflation. That simply means the rise in prices that happens over time. And because prices are going up all the time, you shouldn't be holding your savings in cash. If you hold your savings in cash, then in the future, you won't be able to buy as much with that cash as you would be able to buy now, simply because your cash isn't going to change in value, but the prices of everything will be going up over time. So let's have a look at an example of that. Here I've got the price of a Big Mac over the last 20 years. So back in the year 2000, you could buy one Big Mac for about $2.50, whereas today a Big Mac will cost you about $5.66. So let's imagine that back in the year 2000, you had $10. With that money, you could have bought 4 Big Macs. But if you just put that money into a savings account and it hadn't changed in value, today you'd only be able to buy 1 Big Mac. So that's a real lesson in why it's important not to leave your savings in cash. It's really important that our long-term savings grow in value so that we can beat inflation. But a lot of investors actually want to do a lot more than beating inflation. So here's an example of the types of returns that can be made on the stock market if you invest for the long term and if you pick some really great companies. So here's Amazon. I'm sure it's a company that we're all very familiar with. So back in 2003, which possibly is a year in which a lot of you were born, one share in Amazon was worth $19.57. But today, a single share is worth $3,000 and £300. So a huge increase in value there. And that's a real lesson in the amount of money that can be made if you pick a great company and you hold it for the long term. I'm sure there are lots of people that bought Amazon at $19.57 and sold it at $40 when they'd doubled their money, and they probably felt quite pleased with themselves at the time. But imagine how those people are feeling today, knowing that the price is now $3,300. So if you get it right, you really can make a lot of money with investing. But I do have to say that obviously not every company is going to perform in this way, and Amazon is certainly one of the most successful companies on the stock market. Now, before I go any further, I'm going to pass over to my colleague Tim, who's going to talk a bit about how the city works. And also he's going to tell you a bit more about what a share actually is before we move on to talk about picking shares in a bit more detail. So Tim, over to you.
Well, thanks very much, Rachel. It's great to be on this webinar. I can't see all your faces the other side of this screen, but my job, as Rachel mentioned, is to put some context around some of the things she's going to be talking about, starting with what this thing called the city, and there are lots of them around the world, is actually for and where shares fit into that. Bit of background about me: I'm head of education at Killik & Co. You can tell I work in education because I have lots of interesting books on the shelf back there and a little bit of facial hair too. And my job is, as I say, to put some context around some of the topics that Rachel's going to be taking into more detail. So with no more ado, those of you who've watched, I don't know, Succession, Industry, Suits, any of those series will know that there is this thing called the city, full of people working incredibly hard, doing difficult stuff. But what actually is the city? Well, if you were post-pandemic to take a walk around London, for example, you'd find the financial district is divided into three main sections. The city is often the bit near Bank and Moorgate. For those people who know London well, that's the square mile, so called because you've got St Paul's Cathedral over here, somewhere on the west, Tower Bridge over here on the east, and there's about a mile in between, and you can do the same north-south. So many people associate the city with the Bank of England and that area of London, but actually you've also got further east Canary Wharf, which is like an enormous Hilton hotel you can work in, and then you've got where Killik & Co and lots of fund managers and hedge fund managers are based, Mayfair. Some of you will know that from playing Monopoly, I imagine, and that's where the Killik head office is. And I'll be talking about some more about fund managers and so on later in this series. So today, what is the city for? And obviously we're talking about London today, but I could be talking about New York, Frankfurt, Paris, Tokyo, and in essence, all those busy people creating all those series on Netflix, if you like, what they're fundamentally doing is bringing together two sets of people. And it's really important to remember that. Now, you can bring together these two sets of people in a really simple way, or you can do it in a more complicated way. And those two sets of people are people who need access to capital. So think about companies, for example, looking to raise money, and people who've got capital, they're willing to lend or invest into a company. And amongst the big investors out there, it's not really me, unfortunately, it's pension funds, life assurance companies, and the like. So think of it as an organism, the city, that brings together, on the one side, people that need access to capital in order to, say, grow a business, and the people who are willing to provide it. And obviously, if you need access to capital, you'll pay something for it. You need to offer something. People don't give you money for nothing. And equally, if you are providing capital, you expect to earn some sort of return. So how does it work? I mean, if I'm a company and I want to raise money to build another hotel, maybe not the best choice with the way the world is at the moment, how would I do it? Well, I could approach a bank and ask for a straight loan, like an individual. So I could pledge my future hotel, if it's being built at the moment, as security on a kind of bank loan. And you might think, well, that's fine, and I pay the bank interest and hopefully all goes well. There are other ways to do it. I could create a series of tradable IOUs called bonds. That's taking a loan and chopping it up into tradable segments. Now, we're not going to spend much time on bonds in this first series, but they are, if you want to see it this way, a way of dividing up a conventional loan. And why would you want to do that? Well, actually, for a large amount of money, it can be cheaper to raise it that way. But what we're going to focus on is shares. Now, shares are one of the greatest inventions since the light bulb, if you like, because what they enable investors to do is to put money into a company that could be based the other side of the world, limit their liability, which means that if things go wrong as a shareholder, let's say I've got £100 worth of shares, I could lose £100, but normally no more. Meanwhile, the entrepreneur who's taken my money can invest it, perhaps in a different time zone, I don't have to worry about that, and hopefully make me some sort of return. And the upside on shares is considerable, the downside is limited, hence the expression limited liability company. And it's really exciting because a share is literally a share in the fortunes of another business, the fortunes, expertise and energy of an entrepreneur that could be based the other side of the world, running a business somewhere else completely. And as a shareholder, I will be interested in how the business is run. I'll be interested in the brand, but I don't need to worry day to day about what that management team is actually doing. Now, let's think about this. Why am I going to give this entrepreneur my money by buying a share literally in the business? What is a share in the business? Well, what I'd hope to do is perhaps trade it on. So if I'm buying a technology company, maybe I hope to buy cheap today and sell for much more later, because shares trade in an open market, like apples and oranges, if you like. There's a market called the London Stock Exchange, and I'll come back to that a bit later in the series. So a capital gain, as it's called, is one reason to buy shares. Buy low, sell high. Or I might look at shares as a source of income. So the directors of the company I've just bought into might be prepared to write me a regular check out of the company's cash flow to reward me for being a loyal shareholder. And some companies pay generous dividends, others don't. So it's up to me whether I want to buy shares in a company that offers a big capital gain, perhaps technology sector, for example, or I'm more interested in a steady income by way of dividends, or perhaps I want a bit of both. But bear in mind that if a company is making profit every year, it can't magic anything out of that number. If it's got 100 million of profit, it either pays me some of that back as a shareholder, as a reward, as a dividend, or keeps hold of it and invests for the future. Or I might be interested in the perks. So my mum has bought shares in Thornton Chocolate, I believe, Eurotunnel. She knows nothing about investing, but she likes cheap chocolate and discounted travel to the continent, which were on offer in some of the original tranches. And then there's voting rights. You are an owner, you share part of the business. And that means you can turn up at the annual general meeting, berate the directors, make comments, vote on important matters. Now you'll get outvoted. Tim Bennett, with his one share sitting at the back, is going to be outvoted easily by the big pension funds, the institutional shareholders sitting at the front of that room. But voting rights are important to some people, and voting rights don't come with conventional bank loans and IOUs called bonds. So I'm just going to wrap up this session, and then I'll hand back to Rachel with, okay, so I buy a share, I pay £100 today, let's say. What's going to influence what happens next, whether it goes up or down or stays where it is? And I'll give you 4 quick answers to that question. 1, expectations. What do I think the company is going to do? How much profit will it generate in the future? The more profit I think it will generate, and other people may have a different view, that's the thing about the future, you don't know for sure. The more profit I think it's going to generate, the bigger the gain I might expect to make. Then there's the mood of the market. The market's like a live organism. Millions of people, if you like, all with different views of what could happen next. So sometimes the market's in a good mood, it's exuberant, sometimes it's in a bad mood. So you get big swings in prices, and that might drag the share I've got with it. Then you've got the returns available elsewhere. One day I might wake up and decide, I don't want to invest in a technology company, too risky. I'll sell the shares and put my money into the bank. But as Rachel just suggested, that's not a good idea, because the returns on cash at the bank can be pretty poor. And finally, I should mention this, there's the actions of central banks. Now, I'll keep this very brief, but essentially the central banks over the last 10 years have been sort of turning on this money printing machine, if you like. And the more money they print, the more it chases around the market looking for a home, and shares have become a home for some of that printed money. It sounds a bit weird, like creating money out of thin air, but in essence, that's what the central banks, the Bank of England, the Fed in America, have kind of been doing. And that's helped to lift all boats in the stock market, if you like. Okay, so hopefully that sets the scene a little bit on what's coming. I look forward to seeing you in future Tim Talks, as I'm going to call them, because my name's Tim and I'm talking. But for now, I'll hand you back to Rachel.
Thanks, Tim. So now you have a really great idea about what a share actually is. But something I'd like to talk about is what an index is, because when we're looking at shares, it's quite easy for us to measure the actual performance of those individual shares. We can simply just look at the price. But what if we want to look at the performance of a particular market? We might want to look at the UK market. We might want to look at the US market. We might want to measure the performance of the technology sector, for example. So if we want to do that, we can use something called an index. And an index is just a way of adding together the share prices of a particular group of shares. So you might have heard of something called the FTSE 100. And that's an index. It simply adds together the prices of the biggest 100 shares on the UK stock market. You might have heard of the S&P 500. That's the biggest 500 companies on the US stock market. we tend to use something called the MSCI World. And this is an international index and it measures the performance of shares all over the world. So let's have a look at how the MSCI World has performed over the last 20 years. So I'm going to share my screen again. Hopefully you can see that. So there's the performance of this particular market over the last 20 years. So what I want to show here is that clearly the chart shows that lots of money can be made over long time horizons. So you can see the index clearly has gone up by quite a lot over the last 20 years. But what I also want to show is that the market does crash relatively often if you look at this chart. So the pink patches on this chart do show various market crashes. And the point here is that if you are investing for a long time, it doesn't really matter a huge amount if the market crashes because you've got time ahead of you to wait for the market to recover. So if you look at this chart, you can see that the market has recovered from every single crash that has ever happened. So let's have a look at some of these previous crashes in a bit more detail. The first one, around about 2001, 2002, that's what we call the dot-com crash. So around that time period, that's when the internet was really just starting to take off. And there were lots of companies that were related to the internet or they had internet in their title, and investors simply just piled into those because they thought that the internet was the next big thing. Not all of those companies did well, some went bust, and that did cause a stock market crash. But as you can see, the market did recover. Then later on, we had the financial crisis around 2007, 2008. Again, as you can see, the stock market crashed to some extent by about 50%. So really quite a significant crash there. Slightly later on, we then had a few concerns about Greece, the country. There were some real concerns about the amount of debt that Greece had, and there were some concerns that the country would go completely bust. And that caused some concerns that rippled across the whole world. And again, that caused a bit of a fall in the stock market. And then most recently, we've had the coronavirus crisis. Back in March, when the first lockdown started and people got really concerned about this new virus, we had a stock market crash. The whole market came down by about 30%. But as you can see, it's already recovered. This is possibly one of the quickest recoveries we've ever seen. And one of the reasons why the market recovered so quickly this time round was that there are now lots of big technology companies in the market, and those have actually done well because of lockdown. Because so many people have been stuck at home, that's actually been really good for some of the big tech companies like Amazon, Microsoft, for example, which has been helping people to work at home. So the fact that these big companies, these big tech companies are now in the market, that's the reason why the market has recovered so quickly. So that's how the market has performed over the last 20 years. So now let's move on to the more interesting part. How do we actually pick stocks that we want to invest in? Well, there are lots of different ways of doing this. Some people like to start by looking through the accounts of different companies. Nothing wrong with that, but personally, I find it a little bit boring. The approach that we take here at Killik is something called thematic investing. So what this involves is thinking of a particular theme or a particular trend that we can see happening around the world. And then we think of companies that could benefit from that particular theme. And it's probably easiest to understand if we have a look at an example. So the first example I'm going to talk through is the selfie. I understand that most of you are ages 16 to 18, so I'm sure you take lots of selfies. But 10 years ago, no one was taking selfies at all. We didn't even have phones that were capable of taking selfies. But in 2012, Apple released the first phone with a front-facing camera. And that's really when people started to take lots of selfies. And that was great news for Apple. It was a great phone. People started buying more Apple phones. And that was great for the Apple share price. And then people started sharing their selfies on social media. So that was great news for companies like Facebook and also WhatsApp and Instagram, which are both owned by Facebook. So those companies also benefited from this growth in the popularity of selfies. And then another knock-on effect of that was that people became more concerned about their appearances because they were taking so many more photos of themselves and sharing those photos online. And that actually led to a big increase in demand for makeup. So makeup companies like L'Oreal and Estée Lauder have done really well since 2012, partly because people have been taking so many more selfies. Another company that benefited was Invisalign, which is a company that makes those invisible braces to make your teeth straighter. So this is a really great example of thematic investing. I mean, who would have thought that Apple releasing a particular phone would have led to growth in demand for braces and for makeup? And this is what we really like about thematic investing. It's really forward-looking, and you just wouldn't get this kind of insight or this kind of link from looking at a company account. So we think this is a type of investing that anyone can understand and anyone can relate to. And let's take a look at another theme. This one is online shopping. And again, I'm sure most of you are really familiar with online shopping, and perhaps some of you assume that most shopping in the UK takes place online, but actually that's still not the case. Before the first lockdown, less than 20% of shopping in the UK took place online. So on the slide here, you can see that back in November 2019, only 18.7% of total shopping in the UK took place online. Since the lockdown, that's actually forced a lot more people to try online shopping. And you can see that in November 2020, that percentage had risen quite notably, and about 31.4% of total shopping in the UK took place online in November. But there's still a really, really long way to go if we want to move more of our shopping online. But nevertheless, we've had a big growth in online shopping over the last year. So let's have a think about some of the companies that could have benefited from that. One of the more obvious examples is the online retailers themselves. So companies like Amazon, ASOS, Boohoo, they will have been making much more sales during lockdown, and therefore that will have been good for their share prices. A knock-on effect of that is some of the online payments companies. So previously in the UK, lots of people were still using cash, particularly the elderly generation. They were still using cash to pay for lots of their purchases, but lockdown has forced a lot of those people to use card payments or digital payments for the first time. Another knock-on effect of online shopping is boxes. Obviously, we're using lots more cardboard boxes, and that's great news for the companies that actually make the boxes. We've then got delivery companies like Royal Mail, FedEx, because people are posting so many more parcels. That's great news for those delivery companies because they've got lots more business. And then finally, companies that deal with returns. Returns are actually a huge problem for lots of online retailers. If we take clothing, for example, more than 50% of the clothing that we order online in the UK is actually returned. And when it gets back to the retailer, these companies actually have to check the returns, make sure the thing hasn't been used and it's not dirty. They have to refold them, repack them, and then resend those products out to someone else. And that's a lot of work. So a lot of companies actually outsource their returns to other companies who specialize in them. So those companies that specialize in handling returns have also done very well. So that's a selection of the companies that we believe have benefited from the increase in online shopping. Now, I mentioned that before the next webinar session, I would like you guys to start thinking of some of your own themes and trends and perhaps some companies that you think would be good to invest in. So I'm going to run through a couple of recent trends that have happened over the last few months, and perhaps these will help you to think of some of your own investment ideas. So the first one is electricity generation, moving away from fossil fuels towards renewable power. So renewable power in the UK has had a huge amount of growth in recent months, and we really hope that this will continue. If you have a look at this chart here, you can see how we've had a big change in how our electricity is generated over the last 20 or so years. So at the bottom of the chart in grey, that's the amount of coal that we've previously used in order to generate electricity. But you can see that over the last 3 or 4 years, that's really tailed off and we're not really using coal anymore to generate our electricity. But if you look at the green, that's the amount of our power that's coming from wind and solar. So we've seen a huge decrease in use of coal and a big increase in the use of renewable power. And we really hope this is something that will continue as the world fights to deal with climate change. So that's a big trend that we're seeing at the moment. So have a think about that and consider what types of companies you might think will benefit from this over the next few years. The next trend is a big rise in pet ownership. And so clearly in lockdown, a lot of people have felt very lonely and lots of people have bought a pet for that reason. I believe in 2020, dogs were actually sold out. So that's a trend that's done really well in lockdown. And also the fact that during lockdown, a lot more people have been able to work from home. And that means that a lot more people are now able to have a dog. So that's another reason why we've seen a huge rise in the ownership of dogs and pets in general. So perhaps have a think about what other trends you can see linking into that and what types of companies you think might benefit from that. So it could be things like pet food sales, vet bills, anything at all that you think could benefit from that particular trend. And then finally, we've got streaming services. So clearly these days, there are lots of big, very popular streaming services, Netflix, Disney+, Amazon Prime, Before lockdown, perhaps most people had one or maybe two of these, but after lockdown, it's actually very common for people to have all three. But perhaps have a think about what companies you think could benefit from more and more people getting involved in streaming services. So that's a few recent trends that I would like you guys to have a think about. Something else that we think about when we're deciding what companies we could invest in is wealth distribution. So clearly the companies that are doing well are the ones that are making the products or services that are popular with people who have money. So we do try and think about what types of people have money now and what types of people will have money in the future. So here's a chart that shows the distribution of wealth across different generations in the US. And yes, this is American data, but the pattern will be very similar in the UK and across the rest of the world. So this chart shows the level of wealth in the US over a period of about 30 years, so a very long time period. You can see that over that time, the level of wealth has dramatically increased, and that's partly because the stock market has done well and property prices have done well as well. And so let's look at the amount of wealth that is owned by particular generations. So at the bottom in the pink, we've got people who were born before 1946. And you can see that the wealth of that generation peaked in about 2007. But since then, sadly, a lot of those people will have passed away, and a lot of that wealth will have passed on to the next generation. So you can see that the so-called baby boomers in the purple, they currently own a huge proportion of global wealth. And then above that, we have the so-called Generation X, people born after 1965. Their level of wealth is slowly increasing as those people move ahead in their careers. And then at the very top, in the dark green, we have the millennials. That's my generation. Sadly, at the moment, we own a very small proportion of global wealth. But over time, that will hopefully change. And I'd say the same for your generation, which I assume is Generation Z. At the moment, you don't even feature on this chart. But in the next 10, 20, possibly 30 years, your generation will own a large proportion of global wealth. So what we'd really like to know is what kind of things you guys are into, what you're spending money on, what you're buying, because that could give us some clues as to what we should be investing our long-term portfolios in. So with that in mind, we've got a couple of poll questions that we'd quite like to ask you. So I'm going to share the poll now. Okay. So I'm going to launch the first question. I'll give you a few minutes to answer this. Okay, I'm going to stop it there because I can see that most of you have voted. So I'm going to end that poll. Quite an even spread of results there actually, but I can see that Snapchat is obviously the most popular. So 34% of people are voting for Snapchat. Snapchat is actually listed on the stock exchange, so you can go away and have a look at how those shares have performed. And the next most popular one, which wasn't too far behind, was YouTube. That's owned by Alphabet, formerly known as Google. That's also listed on the stock exchange. So you can also go away and have a look at how that company has performed as well. And I've just got one second question to ask you. Let me just launch the second poll. Okay, I'm going to stop that there. I can see that most of you have voted. That one's actually quite surprising to me. So we know that there has been a huge increase in vegetarianism and veganism over the last few years, and that's led to a real success for companies like Beyond Meat. And we did wonder if perhaps younger generations were more likely to be vegan or vegetarian, but based on this poll, that doesn't seem to be the case. And I can see that 94% of you would not describe yourselves as either vegan, vegetarian, or pescatarian. So another really interesting point there. So thank you very much for answering those questions. I'm going to close down that poll now. We're almost coming to the end, so we'll soon be taking some questions from you guys. So I've just got a few ideas here for places where you could potentially look for ideas. You could go and have a look at the Killik & Co magazine, which is called Confidence. So you can have a look for that on our website, and there are lots of past issues there which should give you some ideas of companies that you can invest in, and also some possible ideas, trends and themes. You could also have a look at a newsletter called Finimize, which I personally find really helpful. It just sends a very basic summary of key financial news to you every day, but it just explains everything in a really clear and easy to understand way. So I'd really recommend that you guys start signing up to that. And also, it might sound quite obvious, but the BBC News business pages, they explain all the key news in a really, really easy, simple way. So I'd recommend having a look at that if it's not something that you would normally use. Now, after this webinar finishes, probably sometime tomorrow, you will receive an email from Killik & Co just thanking you for attending this webinar. And if you do plan on attending the next webinar, I would really like it if you could reply to that email with any stock ideas or any trend ideas that you think will be popular over the next 5, 10 or 20 years. So just have a think about what's popular with you, what's popular with your friends, what are you spending your money on? And perhaps another way to think about it is, what would you buy if someone just randomly gave you £1,000? So just have a think about anything that you think could be popular over the next few years and send those ideas to me. And what I'm going to do, I'm going to put all those ideas together. I'm going to pick a spread of about 20 different ones. And then next week, we're going to vote on what we want to put in our virtual portfolio. And then we're going to start following that over the subsequent weeks. So I'm going to draw it to a close there. So thank you so much to everyone for attending. And I'm just going to have a look and see if we have any questions that I can answer for you. And I can see that Tim has returned to help me answer those questions. And the first question is, do you think that offline retail sales and related shares will bounce back in 2021? And the answer is, I would expect that all retail sales will increase in 2021. I think in lockdown, people have been saving a lot of money because they haven't been able to go out spending it. So I think both online and offline retail sales will bounce back. But I do think that during lockdown, a lot of people will have tried online retail for the first time, and they will have realized how easy it is, how simple it is. And I don't think a lot of those people will go back. Second question. If you're buying a share, do you have to wait for somebody else to want to sell, or can a company increase the number of shares? Let me just think about that question. I'm just going to get it straight in my head.
Can we stay that one, Rich?
Yes, that would be great. Sorry, I had a bit of a mental block there. So yes, Tim, please. A little bit of a break
there. Yeah, so basically the answer is depends on the type of company, first of all, to a degree. So private companies are often owned by a small group of people, could be a husband and wife team, for example, and you're not going to ever be allowed to buy those shares unless they wake up one day and decide to sell a chunk of their company to you. So that's an easy one to answer. Once you move into companies that are raising money from the public, and those are lots of the names Rachel talked about, these are publicly traded companies at the London Stock Exchange, which I'll be talking about in a future Tim talk. But basically, once shares are in the public domain, then normally, if the company is of a fairly decent size, it's fairly straightforward to buy more shares because there'll always be an active market. There'll be somebody selling, and I'll talk about how buyers and sellers are connected with each other. Well, let's say you've got a situation where a company does want to increase the number of shares it's got in circulation, perhaps to raise some more money, because don't forget, cash is going to change hands if it does that. It's inviting people to give it some more money through something called a rights issue, for example. There is normally an obligation to offer, getting a bit technical now, those new shares to existing shareholders first, so that you don't do something called diluting existing shareholdings. But if that hurdle's overcome, then the new shares could be made available elsewhere, if that makes sense. So sorry, it's a bit of a bitty answer, but it depends on the type of company you're trying to buy into, and it depends on whether there are any legal quirks that the company issuing new shares needs to jump over first. And I just wanted to mention at the end of that question, I do have a whole suite of free educational videos under the label Killik Explains on YouTube. I used to work at Money Week, but I didn't have this facial hair then, so you won't recognize me. But those videos go into, in more detail, questions like that one. So there's videos on IPOs, that's how companies issue shares, rights issues, how you trade shares. And I'll be covering some of those topics in later Tim Talks.
Great, thank you, Tim. So lots more questions here. The next one, which I will take, is how long do you reckon it will take for the tourist industry to recover after the lockdown measures end? I think it really depends on how long it takes to get the vaccine rolled out. You might have seen that a company called Saga, which manages a lot of cruises for elderly people, they announced today that no one will be allowed to come on one of their cruises unless they've had the vaccine. However, given the sort of age of their client base, their clients will be first in line to have the vaccine. So I would imagine that industry will start picking up in May, June this year. We've also heard from EasyJet, who have said that they expect demand for flights to be 250% higher this year than it was last year. So I think that does show that there is a lot of demand and that people are really quite keen to get touring again, but it really does depend on if they're allowed to and how quickly that vaccine is rolled out. Oh, great question here. Would you make more money investing in sustainable or non-sustainable companies? I'd actually say that over the last couple of years, this idea of sustainable or ethical investing has become really, really popular. And I think just the fact that so many people are putting money into these sustainable investments will actually push up the prices of those sustainable investments, almost regardless of how well the underlying companies are doing. But ethical investing is becoming so much more popular, and we know that shareholders and also consumers are very keen for companies to act in a sustainable and ethical way. So in the future, we do expect sustainable companies to have a bit of an edge. What else can we answer? Perhaps one for you, Tim. What causes share prices to go up? Is it the demand of other people wanting to buy the shares? Is it how well the company is doing, or is it a mix of both?
So great question. So ultimately, it's a function of supply and demand, which is a grand way of saying shares that are traded in the public domain are priced according to how many people want to buy versus how many people want to sell, like property, like apples, like eggs, like anything else, like cars to a degree. So it is supply and demand. However, when companies are doing well, when people expect companies to do well, naturally that brings in more buyers. And if those buyers can't be satisfied at a particular price, the price starts to rise. So sellers, as in any market, will sense the opportunity to mark the shares up, sell them for more, and buyers will have to pay more. But equally, of course, companies can hit hard times, or people can look ahead and think, oh, crikey, this is not an industry, it looks like it's going to do well. So suddenly sellers are on the back foot, thinking, oh, crikey, do I want to get out of this company now? And who's going to buy the shares from me? And that'll tend to push prices down. So yes, it is supply and demand. It's a market, essentially, and we'll come back to that in more detail in the future. But ultimately, people are always looking ahead, and that's the thing people need to grasp about shares. They're always looking to the future to try and work out whether they should buy now or sell now. And that depends on what you think will happen next. And no one has a crystal ball. So anyone who thinks they can forecast share prices with any degree of accuracy is talking, what's the right word, nonsense.
Thanks, Tim. Next question, do you think that high street shopping will slowly start to die off after COVID comes to an end? Well, sadly, I do think it was already dying off even before COVID was a thing. We've had so many retailers going bust over the last couple of years because people just aren't using the high street in the same way that they used to. So many people are moving online instead, and that actually is a very sad thing. But rather than dying off, I just think the high street will change. So there's still a huge amount of demand for things like coffee shops, independent coffee shops, for example. So I think the high street will still be there. It will just contain different types of businesses. Perhaps one for you, Tim. What type of UK stocks do you think could benefit from leaving the EU?
Oh, that's quite a tricky question to answer.
Okay, that's why I gave it to you.
In a short space of time, that's right. So it depends. So basically, what are going to be the stocks that benefit from Brexit, essentially? And the answer to that, I think, has got to be the stocks that have got the most global outlook, ultimately. I think it's hard to say in the UK what the immediate impact will be because people are still trying to leaf through the regulation. So obviously, stocks related to fishing, for example, they're not too happy at the moment. Some of the financial services companies a bit uncomfortable trying to work out exactly what deal has been struck and what those trade terms are going to mean. So that there are sort of sectors, if you like, that are treading nervously around trying to work out what this exit will mean for their future prospects. And musicians, for example, are in the same boat. Funds that invest in music rights, for example, to what extent will individual artists be able to tour like they used to post Brexit? So there's quite a lot of unknowns around at the moment, but any company that has had and maintains what I call a global outlook will to some degree look past Brexit and leaving the EU and hopefully continue to march on. Rachel, would you agree with that?
I would, yes, I would. Thank you, Tim. So next question, is it ever too late to buy shares in a specific company? We'll probably touch on this in a couple of sessions time when we come to look at company valuations. So there is a way of deciding how much you think a particular share should be worth. You've probably seen some shares like Tesla, for example, which have just gone up so much over the last few years. And you might argue that perhaps those shares are a bit overvalued. But in truth, it's very difficult to predict. So when we come to that valuation session, we will give you a few tips on how to decide if a share is overvalued and if it perhaps is too expensive to be bought right now. So we'll come on to that in a few sessions' time.
And perhaps I can just caveat that, Rachel, if that's okay, by saying that, personally, single stock investing is really for the Muppets in a way. I mean, punting your money on a share in the hope it goes up is, about the same as punting on a horse or the outcome of a football match. In fact, I might have more success on the latter two in some degrees. What we're talking about here is building diversified portfolios. So I'm always wary about sort of people saying, when's the right time to buy a particular stock? Well, if it's part of a well-structured portfolio, there isn't arguably a bad time. But anyway, that's something that Rachel will take on in more detail later, I think.
Absolutely. Yeah, thanks, Tim. Another question we've got is, when is a good age to start investing? I would say it's never too early. Clearly not everyone has enough money to start investing very young, but it's never too early to start learning about it. And that's why we think this idea of a virtual portfolio is a really good thing to do, because you can learn about it, you can make mistakes without losing any real money. So it's never too early to start having a virtual portfolio. And when you do start to get a job, when you do start to be able to save a bit, there are now lots of platforms out there that do allow you to invest a small amount in the stock market every month. So Killik, we have one called Silo, S-I-L-O, but there are lots of other similar platforms out there that can help you to invest with little amounts if you're investing frequently. So I've got lots of questions here, so I'm just sort of sifting through. Another one for you, Tim. What are the benefits of making a company public versus private?
Very good question. So let's think of an example. So Richard Branson's Virgin Empire has been all things to all investors. It's been private, it's been public, it's been taken private again. So I suppose what's going on there, what was Branson's thinking in going from private to public, then public back to private? In essence, if you want to raise a lot of capital, there does come a point where you need to tap the biggest investors in the market, and they tend to be in the public domain, the big pension funds, the big life assurance companies, the sovereign funds, whatever it happens to be. You can raise a lot of money privately, private equity and so on, away from the public gaze, but beyond a certain point, and this is where you get these unicorn stocks suddenly appearing on the market, to expand, you tend to want to bring in the public. But in bringing in public money, and by that I mean institutional money, retail, which means people like me, for example, by inviting that money in, you do subject yourself to a higher regulatory bar in many ways. You subject yourself to quarterly reporting in many cases. You've got to keep the market, Mr. Market, as I call it, happy. You've got to keep him up to date. You've got to keep him informed. And of course, the press get on your case. Public companies tend to be subjected to a lot more scrutiny. Now, that can be a good thing if you've got an ego, but for some chief executives, it can turn into a bit of a nightmare. And some of them, without naming names, don't like the spotlight being turned on parts of their empire that perhaps they'd hoped it wouldn't be. So, there are various pros and cons to being private as opposed to public. But for some companies, moving from one to the other is a function of just needing to raise a certain amount of capital.
Thanks, Tim. We've just gone past 5:45 now, so I'm going to stop us there. Any questions we haven't had a chance to get to, we will try and come back to you directly on email. As I said, you'll get an email from us tomorrow about this webinar, and if you could reply to that with any investment ideas, any investment themes that you think would be good for us to look at, that would be really very much appreciated. So thank you to everyone who attended today, and we look forward to seeing you in the next session in 2 weeks' time. Thank you.